Good morning or good afternoon, depending on where you are. Welcome to this week's Sip and Solve. My name is Dan Meter, and I head up our Experian Business Information Consulting team. So, if you have your beverage of choice in hand, let's get started. It's one thing to identify small businesses who are likely to respond to your offer, but it's another to identify those who are ready to buy now or in the very near future. And it follows that this should increase booking rates and improve return on investment. In addition, this should help better identify messages that are most likely to resonate with a motivated prospect. And I think we can all agree that the timing is everything when it comes to these things. So in today's session, we're going to discuss the concept of in-the-market models. The promise of an in-the-market model is to accurately predict the likelihood someone will be in the market for your product, whether it be a credit card, let's say, or a loan, a lease, or other form of commercial financing. And with the business landscape constantly changing, knowing who are the motivated prospects could give you the edge you need to compete effectively. Now, the challenges you face as marketers are steep, as we all know. You're facing multi-layered pressures of trying to maximize revenue. You have scarce selling resources. At the same time, you're trying to fend off competitors who are constantly trying to take business from you. And as if this isn't enough to make you feel like you're living each day on the edge, you also need to operate efficiently and cost effectively so you can meet your ROI commitments. So understanding all these challenges, let's think for a second about approaches to solving them. Now, what do you think brings you the highest likelihood of success? Maybe a shotgun approach? Well, clearly no. I think we all recognize the need to be as targeted as possible. But interestingly, and this might surprise you, many of you are not taking advantage of the tools that are available to you. This statistic from a CMO magazine survey that was conducted in February of this year was interesting to me anyway. Said only 6.6% of marketing budgets are allocated to marketing analytics for B2B products. Like I said, that seemed to me kind of small. It is up 2% from the February 2017 survey, and this most recent survey indicates that it's expected to accelerate to reach about 11.5% by 2022 for B2B products. I give you a little means of comparison. B2C product marketing analytics spend is currently about 5%, and it's only expected to reach 7.5% by 2022. So clearly, the trend in B2B is much more aggressive than B2C in terms of marketing analytics. The reason I bring this up, though, is that in the context of our discussion today, the use of analytics to identify motivated buyers may be a missed opportunity that you want to consider, even with a light pool of resources you may have earmarked for marketing analytics. Now, there are observable behaviors of those who are in the market, or at least showing indications that they may be in the market in the near future. These motivated buyers really provide your best opportunity for generating the most efficient return on your marketing spend. And it becomes an analytical exercise to try to tease out those who are showing signs of being in the market. This could be as simple as a single score, or it could be an elaborate analysis that covers multiple periods of time as prospects evolve from being just prospects into hot leads. Now, regardless of which approach you take, we tend to look at it as a data-driven four-stage process. First is to establish a foundation of reliable data on which to build out your analysis. Second phase is once you're confident in the data you have, to begin profiling the prospects that you're looking for. And then from there, developing a contact strategy and then tailoring an offer that's attractive to that segment. The ability to incorporate a score that can be highly predictive of the likelihood that a small business is motivated to buy can really be a terrific tool that can help inform on who you target and also provide a basis for contact and offer strategies. And using an assessment of who's in the market cuts across several types of outreach, from prospecting to cross-selling and upselling to retention strategies for existing customers. I guess the pure prospecting use case is probably self-evident. You want to find new customers that are ready to go now. But having that assessment in hand can really be highly effective in maximizing existing customer potential. Since making the most of customer relationships is crucial to growing your business, using in-the-market models can help You identify those in your current portfolio who are also likely to be in the market now and who you might consider as a cross-sell or maybe an upsell opportunity. And, you might as well leverage the relationship you already have, so why risk losing an opportunity to fill someone's need with someone who already knows you? It just seems like a great opportunity and a great advantage. And this can also extend to retention. If the analytics show that a current customer is sending signals that they're looking into new financing options, you may want to move proactively to shore up the relationship before you lose that customer to a competitor. And at this point, you might be asking yourself, or asking of me, how does this all work? Well, first, we determined that rather than trying to identify the likelihood of meeting an in-the-market definition at a single point in time, we think looking to see what the likelihood is within a near-term window was most beneficial. So our approach is to predict the likelihood of being in the market within the next 3 to 6 months. We believe this provides a better and a more targeted pool of prospects. Second, if it offers an opportunity to monitor for changes in purchase likelihood over several months in order to drive the best results. We've seen in our research that it isn't necessarily the score for a business in a given month that drives the best prediction. It can be tracking that business over time that can yield the best view of their level of urgency. Now, to do this correctly, it can take a fairly detailed analysis, so this approach may not be for everyone, but if you have the time and you have the means, it can provide a refinement to your results that should drive incremental benefit over just receiving a score at a single point in time. So the data we've looked at to build out our scores come from our commercial credit database. We've found a number of traditional credit attributes that are excellent predictors of being in the market. As you can see from the chart, the top predictors of likely to be in the market are depth of credit and type of business, which represent about 2/3 of the predictive power of the model. Secondarily, we've found public records and inquiry trends to show some predictive power as well. The resulting scores we've produced have shown some pretty strong indications of the likelihood that a small business will be in the market within that 3 to 6 month window. It might also be beneficial to consider a more refined analysis that perhaps tries to identify a specific product. So this model predicts the likelihood of a commercial product, the likelihood of someone being in the market for a commercial product. But you can get more refined down to a loan or a card or whatever it might be that you're interested in. If this is your interest, it'd be a good idea to speak with one of our representatives who can connect you with one of our analytical consultants to discuss what options might be available. Now, in terms of predictiveness, the score we've developed has performed really well. 80% of the booked applications in our historical analysis were captured in the top 50% of the score range. That's what that chart shows. That intersection of the two dotted lines is at the point of 80% of the booked applications, and as you can see, it's 50% of the population. From an implementation perspective, and when you measure trade-offs with campaign cost, we've typically seen scores that are in the top 30%, capturing the optimal level of prospects. If you take a look in the chart, you'll see that that capture about 60% of the likely booked applications. Now, where you set that cutoff would be based on your campaign goals. So the top 30% figure is only a starting point. You may want to let in more prospects. You may want to let in fewer. And plus, as I mentioned before, you can conduct some additional analytics, and particularly when you consider how scores are trending. And that could further refine the parameters that you use for pulling prospects. So rather than set a single cutoff, you might have a couple of different cutoffs depending on the segment that you're looking at. That, of course, would take some additional analytical horsepower to pull that off, but certainly can help refine and create a more targeted list for you. Now, we've talked a little bit about looking at scores that trend over time, and they can change pretty quickly, as you can imagine. I mean, we're predicting the likelihood that someone will be in the market in a very, very short time window of only about 3 to 6 months. Plus, if you consider that the time a small business is actually in the market can be fleeting. The amount of time a small business owner spends shopping can depend on what type of product they're looking for. So, for example, a small business owner might take a more deliberate approach to shopping for a loan as opposed to a credit card. But regardless of how you look at it, you want to be on top of any score changes, as they can give you important insight to identify a prospect early in the process. This way you can reach out to them when they're most open to hearing your message. And again, as I said, timing is everything. So if you're able to trend the scores and pinpoint a time when it looks like they're ready to listen, you can get out, you potentially get out in front of it and beat the competition. I'd like to talk a little bit about a case study. This is a case study from an analytical exercise we did around looking at scores over multiple periods. The goal was to measure the effect of looking at scores over time in order to refine the criteria for a hypothetical mailing by trending the in-the-market scores for a portfolio of businesses. We were able to identify segments that had higher booking rates when layering in prior month scores than if we just looked at the current scores by themselves. It was a fairly complex analysis we undertook, but the resulting refinement in selection criteria created a more targeted set of prospects that would have produced a 5% higher booked rate with 7% less mail volume. So as you can see, a nice little return, less cost in terms of mailing, but a higher book rate at the same time. Now, in order to be able to do this, it is important that you engage with an analyst or a consultant if you're looking to improve performance by trending scores rather than just looking at a single point in time. There can be a few ways of looking at the data, so in order to get the best possible performance out of the exercise, it's always good to work with someone who has experience structuring the analysis to fit your needs. Now, one last chart I'd like to walk you through while we still have a few minutes here. Talks a little bit more about implementation considerations. And this chart shows you how you might treat prospects across the two dimensions of ready to buy and likely to approve. So not only covering the in the market component, but also covering a risk component. Best prospects, as you can imagine, can be found in that upper right quadrant, the ones that show the highest degree of need for a financial product, but are also low risk. Now, competition for these will be heavy, as you can imagine. So being able to have some extra insight can give you the opportunity to craft a winning offer to that segment of prospects and help you get in front of them, hopefully, before the competition does. Now, for those on the other end of the ready-to-buy spectrum, that would be in the lower right corner. That would be low current need, but also low risk. You may find these to be the best candidates for monitoring. Perhaps you might even want to employ a nurturing strategy in the expectation that a segment of this population may soon be in the market and ready to buy. By monitoring these prospects, you have an excellent chance of picking up an early warning that they'll have a need for financing. And this could provide you a competitive advantage and given these businesses are identified as low risk, you'll want to get a jump on the competition with the right offer here, just like we talked about in the other. Although by monitoring, there's a good chance you might spot the growing opportunity faster than a competitor who isn't doing the same. And then finally, there are segments of the lending community that are strategically positioned to take on those highly motivated prospects who are also high risks. That would be the upper left-hand box, the high need, high risk category. These small businesses may have trouble obtaining funding through traditional sources. So isolating that segment can provide a pool of ready-to-move prospects that may be greenfield if your customer acquisition strategy is set to maximize opportunities with those high-need, high-risk small businesses. So we're coming up on the end of our time. I just wanted to say thank you very much for attending. If you have any questions or want to learn more, please don't hesitate to reach out through the link you see on the screen. And don't forget to stay in the loop on future Sip and Solve sessions. Hope you all enjoyed your drink of choice. And again, thank you for joining us today, and we will see you soon.